Thank you, Ben. I hope everybody can hear me, and I hope everybody's doing well. I know in my neck of the woods, it's been very nice and sunny the last 2 days, so I know a lot of people are out in the fields working away very hard. So thanks for participating. Just to correct a bit of that bio, I used to be a president and treasurer of the Hanover Chamber. I retired from that too. As I get older, I'm retiring from things. So we're going to go through some topics here. One that is on the capital gain changes, the proposals, a few slides on the Canadian Entrepreneur Incentive. I'm not going to spend a lot of time on that, but just so people understand what it's about. And we'll talk about the alternative minimum tax changes. I think what I want to sort of preface this all with, and some of you may know this, is, we had the budget on April 16th, significant changes. We did not have any draft legislation for a lot of it. They did come out with a bill not too long ago for some of the budget changes, but the change to the capital gains inclusion rate has been sort of carved out from that. It was not part of that bill. So as we sit right now on, May 16th, we do not have draft legislation on the changes in the capital gains inclusion rate. So it's very hard to advise when we don't have legislation to read. That's sort of what we go by, right? And are there going to be significant changes made to what's been proposed? We don't know. So we'll touch on that a bit as we go along. So what's the big change? Some of you have heard that they're increasing the capital gain inclusion rate for individuals earning more than $250,000 in capital gains in a year from 50% to 66.67, or 2/3. So right now, when you have a capital gain in Canada, half of it goes half of it goes on your tax return, so half of it's taxable, and the other half you basically put in your gene. So if you sell something like a cottage and you had 100,000 capital gain on it, 50,000 goes on your tax return, the other 50,000 doesn't go on your tax return. It's not taxable. They're proposing to increase that to 2/3 is taxable, 1/3 is not, and only for individuals if it's over 250,000. If it's up to 250,000, you'll still get the 50/50. For corporations and trusts, unfortunately, they are increasing it also to 50% to 2/3, but they have not at this point allowed corporations and trusts to have this, what we call this first 250 exemption sort of harbor, where you're getting the 50% inclusion rate. Right now, that is not available in the proposals for corporations and trusts. So what does this do to us? So in Ontario, and I highlighted Ontario in red, right now, capital gains realized before, and sorry, I should have said that this is to be effective for dispositions or sales on or after June 25th, 2024. So right now, if you realize a capital gain before June 2025, or if you're under the new rules and you're below that 250 threshold in a year, your top effective rate is 26.77%, basically. If you have a gain on or after June 25th or after June 24th, or you're over that 250, any gain over the annual 250 limit, that tax rate has now gone to 35.69%. And there's the increase is about 9%. Okay. It gets a little more convoluted in a corporate setting. So here is a chart on the capital gains realized before June 25th, so under the current 50% rate, and flowed out through the corporation. Our flow-through rate, which is the middle one there, is 28.97%. There's a bit of a tax deferral in a company on gains, but if you flow it all through a company out to yourself personally, there's actually a little bit of a tax cost there. So for corporations now on gains realized up to 250,000, because they don't have that exemption. Remember, the first 250 for individuals is taxed at a 50% rate rather than 2/3. I know this gets a little complicated, but basically the flow-through rate in a corporation has now gone up to 38.92 or 38.62%. So you can see that's about a 10% increase in that flow-through rate that I showed on the previous slide. When you compare that to the personal rate, because individuals still get the first 250,000 of capital gains at the lower rate, at the 50% inclusion rate, there is now quite a significant, close to 12% cost of flowing those capital gains through a corporation where it's below the 250, comparing personal to corporate. Where it's over the 250, which means an individual will have to put 2/3 of that cap gain into their taxable income, comparing it to the corporation, it's a lot closer, because all of a sudden the individual's at 2/3 that they have to put on their tax return instead of 50% once we're over the 250. So the government's making it complicated and difficult. And you can imagine for 2024 tax returns now, when we do finally get legislation, we're going to know where people have capital gains, obviously, when the capital gains were triggered. Were they triggered before the effective change date? Were they triggered after the effective change date? So there's still a lot of uncertainty on how we go about doing that. As noted in the slides, and I know that's a lot of numbers there, but one of the big issues is the lack of integration for corporate capital gains inside a corporation that are less than 250,000 a year, because they haven't given corporations or trusts that first 250 sort of exemption at the lower rate. So when we're comparing corporations to individuals, like I did on the previous slide, there's a much higher tax cost flowing it through the corporation. And this all comes up to, and there's lots of questions. People have lots of questions, lots of calls, reaching out to their advisors, accountants, lawyers, financial advisors. What do we do? Do we actually sell assets before June 25th, 2024? If you do that, you have to consider all sorts of other costs. If you're selling real estate to a family member, for example, is there land transfer tax? There's legal fees. There's just the cost to do these things, of disposing of things on top of the tax costs, right? The other big question we have for the government is deemed disposition of assets on death and somebody who leaves the country, particularly on death, because in Canada, when somebody dies and they're not leaving something to a surviving spouse, or they're not leaving qualified farm property to a child, there can be a large tax bill on death if they, unrealized capital gains, like on a cottage or whatever that they're leaving to their children. And there's the question as to whether that's fair, and whether, capital gains on death should be exempted from the higher inclusion rate and still be eligible for the lower inclusion rate. If you want to trigger gains before June 25th, how do you go about doing that? You need to chat with your advisor on that. There's a number of different ways to do it, depending whether it's real estate or other personal property or corporate owned property or shares of a corporation. So there certainly are ways to do it, but there's a lot of variables, unfortunately, to consider. One sort of the time value of money. If you're going to hold the property for, say, another 10, 15, 20 years, and do the math, it probably will tell you it does not make sense to trigger the tax early and pay it now, to leave it, because you're going to have that extra tax money for as long as you keep holding the property. The other thing that sort of is causing, some pain in doing these analysis of triggering lots of capital gains is the new alternative minimum tax. And I'm going to talk about that later. But those rules have changed substantially too for Jan 1st, 2024. And they were announced previously. They weren't in this budget, but they were in before the previous. And this budget tweaked it a bit, and we'll go through that. But the AMT, we're finding when we do that math, and to be honest, AMT is a complicated calculation. You have to do the math. But we are finding that the alternative minimum tax is increasing substantially for some clients where they're triggering capital gains. And we'll go through that in a bit. So you sort of have to take all those costs into account. I mean, if somebody said, I got a deal, the deal's done, I'm selling something that's closing and it's going to close after June 25th, would you say push it up before June 25th? I think absolutely. I think you'd want to look at that. We're still not sure if the government's going to push out the effective date. We just don't have answers to those things. If you trigger gains inside a corporation because you want to get access to the 50% versus the higher rate on or after June 25th, it can affect a lot of things inside the company too. One thing inside corporate groups, if you have the small business deduction, if you have too much investment income, it grinds the small business deduction. It starts reducing what you have access to. So those are variables that need to be looked at also. And the other thing is the capital dividend account in a corporation. So right now, if a corporation sells an asset with a $100,000 capital gain, half of it goes on the corporate tax return. It's taxable. The other half goes into what's called the capital dividend account, and that can be paid out tax-free to the shareholders. It's basically saying, hey, you still get a tax-free component as if you held it personally. So that can be paid out tax-free with the proper paperwork and resolutions and whatnot. Obviously, what gets added to that tax-free account with the higher inclusion rate will just be 1/3 of the gain instead of half of it. So if once these rules are in place and there's dispositions subject to 2/3 going on the tax return, then 1/3 will go to the tax-free capital dividend account. Factors to consider, and I sort of covered those off now. What is your desired timeline to hold the asset? That really impacts the time value of money. What also impacts the time value of money is using sort of what rate of return or increase in value do I expect to get on this asset, say over the next 10 years, 15 years or whatever. Because you can do present value calculations and sort of calculate, well, what's a break-even number of years based on the increased tax if I sold it later versus now? How many years do I have to hold that property at what rate of return? That would tell me not to trigger the tax now, that I should just leave it be and it'll be taxed under the new rules later. The problem with having no guiding legislation, it's very difficult to advise. We're just going by the proposals as we know them. And, will those change? We don't know at this point in time. The other big change that's proposed, which is a positive change, is that the lifetime capital gain exemption is going to be increased to 1.25 million for dispositions, on or after June 25th. So the same date. So right now we're a little over 1 million. I think it's 1,019,000 or 1 million and something for 2024. It's going to go to this 1.25 million. Again, that's for qualified small business shares, qualified farm and fishing property. And so that's very beneficial. So you get the lifetime capital gain exemption first, the 1,250,000 going forward after these changes. Then you also every year get this 250,000 limit where only 50% of the gain goes on your tax return, just as it does now. And then once you're over those, so the 1,250,000 plus the 250, once you're over those, then any gain over and above that would be included at the higher rate, the 2/3 basically. So the 1,250,000 increased to 1,250,000 is certainly, a welcome change. Maybe not enough in a lot of people's minds, but a welcome change nonetheless, right? So, again, just to reiterate on the uncertainty, so there's been submissions made to finance on these rules and the concerns that professionals and advisors have with these rules. The one I sort of highlighted here was made by the Joint Committee of Taxation, Canadian Bar Association, and CPA Canada, basically saying we need more time. Why not make the change date the end of the year, Jan 1? The tax revenue to the government will be the same. Interesting, in the budget, the tax revenue for 2024 that they projected in the budget when they presented it on April 16th, the tax revenue significantly increased for 2024 because of these changes. So they do expect people to be triggering more tax. The other thing we have is treatment of capital gains reserves. That's where maybe you sold something and you're taking payments over time, so you claim a reserve every year. Our thought process is historically, you claim a reserve in 2023, that becomes income on your tax return Jan 1, 2024. So we think that will be, at the 50% inclusion rate. But what if you claim a reserve on that again at the end of 2024 because you haven't been paid and it moves it into 2025, 2026, and so on? You can do a 5-year reserve, and with children, with farm property, you can do a 10-year reserve, so it can spread out over a lot of years. Will those be grandfathered? Will they still be subject to the 50% inclusion rather than the higher 2/3? We don't know. Will there be grandfathering? Like if somebody sold something before the budget date, they had a legally binding sale, but the sale simply not closing till sometime after June 25th, will that be grandfathered? Will they be able to use the 50% rather than the higher 2/3 inclusion rate? Why not have an election mechanism? Many of you maybe will recall, or maybe not. I was practicing at the time that in 1994, the government allowed a one-time election, February 22nd, 1994, when they took away the general capital gain exemption. People were allowed to elect on things like cottages and investments and things like that. And you filed a piece of paper saying, I am hereby electing to trigger this gain, and you'd pay the tax on it, of course. But it was a lot easier and simpler to do by filing in a piece of paper than actually having to sell the cottage to somebody or gifting the cottage or going through all those transaction costs and professional fees and everything. So we've asked the government, or the joint committees asked, why not have something like that? There's precedent for that. What about capital gains and partnerships and trusts? Technically, particularly with those entities, they have a capital gain before June 25th this year. Those gains don't get allocated technically till the end of the year, which is obviously after June 25th. Are they going to say, okay, well, that's fine. They were triggered before June 25th, so they're at the lower inclusion rate rather than the higher one? We don't have legislation to say that to be the case, right? Corporations I talked about, like, really need to fix the integration problem. Why are corporations and trusts? And when I say trusts, I mean estates. There could be people who have qualified disability trusts for a disabled family member. There can be ongoing estates from a deceased family member. There's lots of good reasons to use trusts and estates. And corporations obviously are used a lot. Why are they being penalized in effect and not being allowed a $250,000 limit per year at the lower inclusion rate? And this $250,000 per year per person for an individual, is it static? Is it going to be indexed? Like, is it going to go up a little bit every year? And what if you don't use it in a year? Do you get to carry forward what you didn't use? Most capital gains aren't evenly earned every year, right? They're very lumpy. You sell a farm, you sell a cottage, you sell another property, you sell some investments. It's not 250, you maybe have to plan for it under these rules going forward, but gains can be very lumpy, right? We have lots of clients who report normal income year after year after year, and then in one year they've sold something and have a significant capital gain. Wouldn't it be nice if this 250 that you didn't use in a year could carry forward at least for some time period? Maybe they put a time limit on it, but it would be fair, I think, to let that carry forward. I think it would be fair to let that be indexed. And again, these are suggestions made to finance that we've not heard, at least to my knowledge, we've not heard any feedback on. The capital gain on death I talked about, we would hope the government would give some relief there. We have a lot of clients, a lot of people out there who've done their estate planning, done their wills based on the way the taxation system is now. And those people don't have capacity to change their wills, maybe, right? And a power of attorney can't change the will. So now you're upsetting plans that possibly couldn't be improved. People who've put life insurance in place to maybe cover tax on, the family cottage or something like that, or farms. And those people maybe no longer be insurable. Maybe they can't get any extra insurance to cover the increased tax cost on the capital gain. And to be honest, as Canadians, we've had a 50% inclusion rate has been the norm for decades. We had a period of time where it was 75%, then it went from 75 down to 2/3 down to 50. But the norm for us as taxpayers in Canada has always been a 50% inclusion rate. And this is sort of upsetting the apple cart. Now, the budget document said this change to the capital gains inclusion rate to increase it to 2/3 and this 250 exemption limit per year for just individuals, not corporations and trusts. This change in the budget document said would not affect more than 0.13% of Canadians. I find that very hard to believe. A lot of people I talk to find that very hard to believe. We're not sure how they came up with that number, but we think this affects a lot more than 0.13% of Canadians, we think. One of the things in the budget, just to bring it to your attention and not to get into it a whole lot, is they did introduce what's called the Canadian Entrepreneurs Incentive. And there's a bunch of conditions around this, but basically what it'll end up doing when it's fully implemented is it'll allow the entrepreneur who's selling their shares, and it's only for incorporated businesses. So the entrepreneur selling their shares to have an inclusion rate of 50% of the regular inclusion rate on the first $2 million of capital gain. And they're phasing this in over 10 years at 200,000 a year, starting Jan 1 of next year. So the idea, like if we have a capital gain inclusion rates of 2/3 going forward, and you qualified for this incentive, the first 2 million of gain would be at 1/3 because it'd be at half of the 2/3 inclusion rate. And this would be in addition to the lifetime capital gain exemption of the $1,250,000 that they're proposing. So this would be on top of that. And so there's a number of conditions around this incentive, and I'm not going to get into all of them by any means, but one of the main ones, which is it might be a little difficult for some folks, is the person claiming this has to actually be the founding investor at the time the corporation was initially set up or capitalized, and they have to held it for at least 5 years, and they had to get their shares at fair market value. And there's a number of other tests around there that have to be met. The claimant being the founding investor, that can be tough in a family business. Like I know with our family business, my dad founded it, and he's no longer with us, and my two younger brothers own the family business. They technically wouldn't qualify, right? Because they were not the founding investor at the time the corporation was capitalized. Again, maybe we'll see some changes to that to make that a little more available to other entrepreneurs other than the founding investor. So minimum tax. So I'm jumping around. So with minimum tax, that was announced some time ago. They're broadening the AMT base. We call it AMT, alternative minimum tax. They're raising the exemption. So the exemption is the amount of income you can have without adjusted income, because it's adjusted for minimum tax, but it's the amount of income you can have that's not subject to minimum tax. The exemption for years had just been 40,000, quite low. It's now jumping up, and it's going to be the fourth tax bracket. So for 2024, that's 173,205, and you might go, well, that's great. Then minimum tax will never apply to me. But we'll get into why that's not necessarily the case. And they're increasing the AMT rate from the tax rate from 15% to 20.5%. So a lot of proposed changes, like with the AMT. So the capital gains right now are included at 80%. They're going to put them at 100%. So they're all going in. The nice thing is capital gains that you claim the capital gain exemption on for qualified farm property, qualified small business shares, that will stay at the 80%. It stays as it was. But they're decreasing the inclusion rates for losses that are carried forward from 80% to 50%, including 100% benefit of stock options. If you donate publicly traded securities to a charity, right now you don't have a capital gain when you do that. And they're adding 30% of that gain and calculating minimum tax. And they're disallowing 50% of various deductions that are sort of listed there. And then they're allowing only 50% of non-refundable credits to reduce AMT. So all these little changes all add up to a lot more complexity and the ability for AMT to apply in a lot of situations, okay? And the math needs to be done. So as a simple example, I tried to show, how the change could be. I have somebody who sold some shares in 2023. They used their lifetime capital gain exemption. So they were qualified family farm corp shares or qualified small business corp shares. This person happened to also earn another 350,000 of capital gains on other investments they had. And they were nice enough. They've done well. They have, some securities in their investment portfolio, mutual funds, stocks, or whatever, and they donated some of those to a local charity, their local charity, and those shares that they donated to the local charity had a capital gain of 100,000 on them, which generally, when you donate those types of shares or publicly traded securities to a charity, you don't get taxed on that. You don't report that capital gain, but you get a full donation tax receipt. So it can work quite well. So basically under the rules, you know, they have the taxable capital gain on the shares. They have the capital gain on the other property. So 50% of it would be 175. They've used their capital gain exemption, which is shown sort of down here, 485, 485. There's their taxable income, which makes sense. It's just the 175 on the half of the 350 gain they had. And that's their basic tax. So that's before minimum tax. You know, the basic tax isn't bad because they gave us pretty significant donation. When we get into the minimum tax under the current rules, their AMT would be about $48,000. So the previous slide, I showed regular tax of about 6 or something, right? 48,000. Under the new rules as proposed, that goes to 88,000. This is a simple example, but just to show the great difference in minimum tax that can apply and why is that happening. So if we go, you know, we had taxable income of 175,000. We add in 30% of the gain on the qualified shares because that didn't change. I said those rules are staying the same. But under the new rules, we're putting in all the capital gain on the non-eligible gain. So 50% is getting added in at 175,000 rather than 30% at 105. They're also adding in, which, you know, to me doesn't seem fair, but they're adding in 30% of the gains on these shares that this person nicely donated to their local charity for 100,000, had 100,000 gain on them. They're adding in 30% of that. So now our adjusted income's gone from 571 to 671 under the new rules. The exemption's gone up, absolutely. Now that's the 2023 exemption, 165,430. It will be 173,205 for this year, and it's going to be indexed. But the rate's gone up from 15% to 20.5%. So then all of a sudden there's more tax, 103 and change versus 79. And they're only allowing 50% of non-refundable credits rather than all of them. So that again increases the tax here. I put a note there that the budget, this year's budget, does propose that the non-refundable tax credits related to donations be allowed at 80% instead of being restricted to 50%, because they were getting a lot of blowback from registered charities and other organizations about taxing Canadians who are willing to give such, you know, significant donations to charities to you know, to help society, right? So there has been a bit of a change there. But this just sort of reflects the magnitude of the change. You know, AMT under the current rules, under the proposed rules, less what your normal tax would be otherwise. There's the AMT available for carry forward. So we're finding, you know, you got to do the math and work through it. And if you're triggering gains on purpose before June 25th to get that 50% inclusion rate, it's very important to model out the AMT and understand what your AMT liability is going to be, so that come next April, you're not in a big shock when you have a large tax bill to pay. Now, AMT is recoverable. So with AMT, if you pay it, you have the following 7 years, the 7 years after the year it's been triggered, to recover it. Now, you can only recover it in each of those 7 years to the extent that the regular tax that you would have, so this Part 1 tax you would have on your normal income, the regular income tax you would have, exceeds what the minimum tax otherwise would be in that year. So going forward, if you have, you know, some large interest income, wages, pension, RIFs, whatever, you may be able to use all your AMT. But it is a 7-year carry forward. And if you look at this example, the AMT went up considerably, right? 40 grand. So now it's maybe just tougher to recover that over the following 7 years versus had it been 42, right? There's just that much more income we have to make sure we have in the next 7 years. That creates enough regular tax over the AMT otherwise payable to suck up all this AMT. Because if you don't use it up in the following 7 years, it's gone. It just falls off the table. It's an absolute cost to you then, the AMT, if you don't use it up in the carry forward period. So these are pretty significant changes. And unfortunately, they dovetail in with capital gains quite a bit and other things you're doing. So it's just always pretty important to spend the time, or your advisor to spend the time and run the numbers and do the math, right? Yeah, so that's my slide here, do the math. So the proposal in the 2023 budget was to broaden the base, which it did. It increased the exemption, but it also increased the tax rate. The 2024 change that they're proposing is to allow 80% of donation non-refundable credits to address concerns that came from the charitable sector. With that change, technically, if you're a high income earner and you're giving some large donations, you're at the federal rate, you're at a federal tax rate of 33%. 80% of that rate is 26.4%, and that's higher than the AMT rate of 20.5. So I think technically, if you're a high income earner at the top rate, the idea is that there shouldn't be any AMT applicable to you on giving a simple donation where you're willing to do that and give that to a charity. Comparing rates. So with the capital gain inclusion rate going to 2/3, the 66.67, and the top federal personal rate is going to be basically 22%, so 33% at 2/3. That's over the 20.5% AMT rate also. So we're thinking if you have capital gains that are not eligible for the lifetime capital gain exemption, are not under that first 250,000 threshold to be taxed at the 50% inclusion rate. So that's the next little paragraph here. Then likely AMT maybe shouldn't apply again if you're a top rate sort of person. So we're just finding in our practice when we talk with each other and with my colleagues that it's just really important to address the AMT as part of all the tax planning, particularly around utilizing triggering capital gains, utilizing capital gain exemptions, all those things. Better safe than sorry. Do the planning, do the math, make sure we understand what the implications are, and hopefully minimize surprises, right? That nobody likes, which would be good. So I think I went through that maybe too quickly. I apologize, but maybe we'll give us more time for a bit of Q&A.
That's great, Kurt. Thank you so much. Yes, we do have some questions in the chat. And a reminder, if you missed the messages I was sending in the chat there, if you do have questions, please type them into the chat now. I'm going to read them to Kurt in the order that they were written. So the first question is if a farm property is sold and one has used up the capital gains, I assume they mean the capital gains exemption previously, are you saying that 66% is only applicable to 50% of the sale? I think they were a little confused on how the math is working on the calculation.
Yeah. So you've used up all your exemption. It's gone. You don't have any more. I guess I got to preface that with the fact that it is going up to $1,250,000, technically June 25th. So you'll likely do have some more exemption, right? Because if you've used it all in the past, then you're going to get a bit of extra, right? But let's say you have no exemption left. So the idea with that, you're bringing a capital gain into your tax return going forward under the new rules. The idea is that the first $250,000 in capital gain each year will be a 50% inclusion rate. So of the first 250, 125 goes on your tax return and 125 does not, right? That's the first 250 threshold for individuals only, again, not corporations or trusts. And then anything over the 250, 2/3 will go onto your tax return and 1/3 will not.
Great, thank you for that. The next one is about the AMT. Does alternative minimum tax apply to final tax returns or estate settlement on the death of a parent owning farm properties?
No, so the one thing about AMT is it does not apply to the final tax return on death. Okay. And if I recall correctly, and I should have checked, but if I recall correctly, the graduated rate estates are now, I think, being given the exemption. They weren't before, or if they were, it was just the basic 40. But I believe, if I recall the changes, that the graduated rate estates too will now have that basic exemption. if I recall that correctly. If not, somebody can throw it in the chat.
Hmm.
But certainly, yeah, it's always been the case that when somebody dies and they maybe have very significant capital gain on death, the minimum tax does not apply in the year of death if you're claiming the gain exemption, for example, to shelter a bunch of that.
Okay, great. Thanks, Kurt. The next question, the person has two questions, so I'll read them one at a time. How will this policy affect farmers who sold land prior to June 25th, 2024? Changes but are using a reserve, i.e., will they be subject to the 2/3 inclusion rate for 2024 and subsequent years, even though they sold the land prior to the changes? That was question one.
Yeah, so that's a really good question. So you sold it obviously before the budget date. April 16th was the budget date. So you sold it last year or 2 years ago. You got reserve coming in to income over 5 years or 10 years. Our hope is that would be grandfathered. We don't know, right? We have no legislation. The reserve you claimed in 2023, in our opinion, comes into your income Jan 1, 2024. So we believe that would be considered 50% inclusion because it's before June 25th, right? That we don't know, but that makes sense. And there's sort of some historical CRA technicals and how they've treated things before that would sort of support that, the way reserves come in the income. So let's say you're doing your 2024 tax return, you bring your 2023 reserve into income Jan 1, 2024. But let's say now you want to claim another reserve the end of 2024 because you haven't been paid it all yet. You're going to push it forward a few more years. We don't know whether they're going to grandfather those reserves, whether they'll say, hey, you had this disposition before the budget date. We're going to let you bring it in at 50% rather than the 2/3. We don't have those answers right now because we have no legislation. And then there's also the people, if you have a disposition between April 16th and up to June 25th, not on June 25th, before June 25th, that period of time here now where people are triggering gains, will you be able to claim a reserve or not and still get it at the 50% inclusion rate? We don't think so. We don't know. Again, we don't have legislation. So if you're triggering gains now before June 25th, I think you have to go on the premise that you're going to be taxed on all that this year at the 50% inclusion rate. I think that's the safe way to do it. And then do the math with the minimum tax, because if you're triggering a lot of gain, that's not being sheltered by gain exemption. Or even if it is, there could be certainly minimum tax involved, right? Because if you think of minimum tax, like I sell something today for 100,000 capital gain, 50,000 of it goes on my tax return and 50,000 doesn't. But for the minimum tax calculation, the whole gain goes in 100,000, right? That's a big change. So all of a sudden they're doing tax calcs with the 20.5% minimum based on my having all the capital gain having to go in my income. And depending on the other income and how much capital gain I have, does that basic exemption cover me or doesn't it? So you just have to do the work and work through it to make sure there's no surprises.
Great. And the second question that same questioner had was, how does this affect the exemption on primary residences? How is a farm family home exempt right now? And are there changes we can expect to see in that regard?
So that's a good question too. Like the principal residence exemption is still a bastion of Canadian taxpayers. They haven't touched the principal residence exemption. That is still there. Will they in the future? Who knows? But that seems to be a political bombshell if somebody was to say, well, we're just going to start taxing principal residents that are sold over a certain dollar amount or whatever. But right now, no, the principal residence exemption still applies, and that has not been changed.
Great. Next question is, would a farmland evaluation before June 24th help with future capital gains?
Yeah, unfortunately, right now, no. Like based on what we know, and again, we don't have draft legislation. So somebody said to me, I'd like to get the 50% inclusion rate before June 25th, but I don't want to pay any tax. It doesn't work that way, unfortunately, the way we understand it now. You actually have to have a legally binding sale. So if it's real estate, you have to have the real estate sold. There has to be change of ownership, possession, risk of use, right? So, if it's my farm or my cottage or whatever I own that I'm going, boy, I want to sell it before June 25th to use the 50% inclusion rate, I got to sell it to somebody. Maybe, or it's a gift. Maybe I'm gifting it to my kids, or I'm selling it to my spouse and electing out of the spousal rollover. Talk to your advisors on different techniques to do that, but you actually have to have a legally binding sale of the property before June 25th to use the 50% inclusion rate. And if you're doing stocks and investments and stuff, I would just caution you to talk to your investment advisor, because they need to do that usually sooner to make sure that the trade settlement date is executed before the 25th of June. And again, is the 25th of June the date? Is that going to be it? Is the government going to stick to their guns on that? Or they're going to come out and say, we're going to extend it, because we really haven't given Canadians any guidance we've given them no legislation. We've just told them, hey, we're going to start taxing you more, and we've not given them any details, right? So it's very frustrating, right? It's very frustrating. And we're hoping to get some feedback. There's been some good submissions made. When I went through the Society of Trust and Estate Practitioners in Canada made a submission also to finance. I'm sure there's lots of other submissions being made with really thoughtful comments that we hope finance will consider in drafting their legislation.
Okay, great. Thank you. Next question is kind of describing a scenario in the question at the end. So we bought a farm property. It was in bad shape, and they've worked on it to increase the value. And with higher interest rates and whatnot, they're looking to sell the property to recoup some of the financial investment. And they're worried about how much more of that sale, the profits from what they've worked on, will go to tax, and are wondering what the solution is to an individual in that situation to kind of maximize the financial protection for the family.
Yeah, yeah. So, everybody's different. That's very individual. But first, at a high level, I would say, if it's qualified farm property for you, and that's a whole lot of tests and things to go through that you can get some help from your tax advisor. If it's qualified farm property, so let's say it's a husband and wife bought a farm, they're working it together, fixing it up, they're farming it. It's going to be qualified farm property for the gain exemption. That come June 25th, that gain exemption is $1,250,000 each. So if you've never used any in the past at all, and it's a 50-50 ownership, that's $2.5 million of gain that's being covered by the gain exemption. Plus you have your principal residence exemption. That's sort of on top, right? Because when you sell a property, if it's your principal residence, and maybe I'm making an assumption, but if your principal residence is on the farm, it's really good to get sort of a value of that sort of separate from the rest of the farmland and farm buildings, because when you sell it, you can carve the principal residence out, sort of set that value to the side and say, that's absolutely all tax-free. That hasn't changed. You do have to file forms with your tax return to tell the government you sold your principal residence. That's very important, as there's penalties, but that carve out is tax-free. And then the capital gain that's left, maybe on the farmland, maybe that's the most substantial part, or maybe on the rest of the property, even the buildings, but whatever capital gains left on the rest of it, as long as it's qualified farm property, would be eligible for your capital gain exemption, which is scheduled to go actually up to $1,250,000 each, and right now it's a little over $1 million each. And what I would say, so you're maybe going, well, that's us. We're farming it as a farm partnership, husband and wife. We'll get our exemption. We get our principal residence. We add that all up. We're good. We're more than covered maybe on the gain on selling the farm, because it is the gain. It's the sale price over your cost, right? So if you bought the farm not that long ago, you maybe paid a reasonable price for it. Maybe you've put a bunch of capital improvements in, built sheds, put on additions. It's what you sell it for over your cost. And then what I would just say again, it never hurts in that case, especially some farms, they're cash deals. You sell it, you get cash on closing. It doesn't hurt to have your advisor or tax advisor run the numbers based on what you think you're going to sell it for, just to give you an estimate of, will the AMT rear its ugly head, because you might have a pretty significant gain, even though it's still going to be coming in under the same rules as we had before, as long as all the gains eligible for the exemption. AMT can certainly still apply when we have large gains in a year, right? Even if they're all sheltered using the gain exemption.
That's great. Thank you for that, Kurt. The next question is, will there be a V-Day valuation as was 30 years ago when the capital gains increase was introduced?
Yeah, so no, so we don't have a V-Day valuation process. We don't have an election process. Those are the things that sort of have been commented back to the Department of Finance. Is we have a history of having a V-Day, right? Back when capital gains first became taxable. We have a history of allowing what's called a capital gain election in February of 1994. Why can't we have that now? So right now, there is no ability to just file a piece of paper to say, I want to, I valued my property. I went and got an appraisal. I figured out how much capital gain there is. I want to file a piece of paper saying I want to pay tax on that capital gain under the current rules. Sounds nice and simple, right? Like we did in February of 94. No, that is not. Again, we don't have legislation, but that was not part of the proposals. And I guess, after doing this for quite a few years, for a budget to come out on April 16th and for the government to say we're increasing the capital gain inclusion rates to 2/3 on or after June 25th is somewhat unusual. They've basically told Canadians you got a little wiggle room, right, to make stuff happen. Because they could have easily announced it right on the budget date, right? Effective on or after midnight tonight. Here's what it is. But we're hoping they're going to give Canadians more time to do this properly, not rush out and make decisions. Like there's so little time, especially if you're dealing with real estate, right? There's just so little time to do it. But anyways, based on the proposals as we know them today, there is no ability to do that, to do an election or a V-Day or whatever.
Thank you. Next, there's two more questions here right now. So next one is, how do capital gains apply upon death of parents on a family farm if they have not put an adult child on title of the property?
Okay, so that's a good question. So again, there's a separate set of rules in the Income Tax Act around intergenerational transfer of farms. And there's rules for transferring them while you're alive. There's rules for transferring them on death. Those rules are not changing, and they're quite beneficial rules. They've been around a long time, and they are saying, we know that there's not a big pile of cash when mom and dad die to write a tax check to the government if the farm's being transferred to children, grandchildren, great-grandchildren who are going to carry on the farming legacy, carry on the business. Having that burden of the tax wouldn't help. So those rules are still there. The ones on death, basically, I'm going to sort of really generalize it, but basically, if the parent says in their will, I leave this farm, lot, this concession, that, whatever it is, to this child or grandchild, and there's no conditions around them getting that farm, those will roll on a tax deferred basis. And all that means is there's no tax. Basically, whatever that farm cost mom or dad now becomes the cost of the child. Now, with those on death, with those transfers on death, what's important from our perspective as tax people is that is the one where we do have the ability to file an election. So, if mom and dad's farm cost $100,000 and mom and dad's farm's worth $3 million today, there's a big gap there. We can file an election when it's transferred to a child on death. We can file an election and actually pick a value between the cost and what it's worth today, trigger that gain, use their gain exemption, increase the cost of the farm to the child getting it. No AMT because it's the year of death. Might be OAS clawback, but usually that's a cost that's reasonable to pay to get this big bump in the cost base to the child. So going forward, the child has less gain when they sell the farm, and the child should also be able to use their farm gain exemption as long as it remains qualified farm property. So that was a little long-winded. Sorry.
No, that's great. That's really useful information. Thank you. We have one more question. Is If a farm is gifted to a family member, is there capital gain on the fair market value of that gift?
Now, another good question. So again, it goes back to these intergenerational transfer rules. So if it is eligible farm property for the intergenerational transfer rules, let's say it's, parents farming, they're full-time farmers, simple example, that's what they do for a living, and they give that farm to a child, the tax rules actually say by default, automatically, that farm will transfer at its original cost. There is no gain. And in that case, to be honest about it, you go, okay, well, we'd like to use mom and dad's capital gain exemption when the farm is given to the child because it's eligible for the farm capital gain exemption. And let's say it's the only farm mom and dad own. It's sort of the last kick at the can when they give that farm to the child. If you want to trigger the gain in that case where you're giving it to the child while you're alive, you actually have to take consideration. You actually have to have the child pay for it. Now, it doesn't have to be cash. A lot of time it's a promissory note or a mortgage or whatever, right? But you actually have to have consideration being realized to trigger the amount of capital gain you want. There's no election. I think, and that's a good question because I think that's sort of a misunderstood out there. When you give a farm to a child while you're alive, there's no election we can file to say we want to trigger this much gain and use mom or dad's gain exemption. We actually have to structure it properly from the get-go. And if there's a principal residence on it too, it's very important that the sale be properly structured.
That's great. And so I said that was the last question, but when I said that, two more ones popped up real quick. That's okay. Quickly, we have two more, if that's all right. What recommendations has CBA and CPA, so these are the associations we're referring to, given to Finance Canada on their proposed changes? I believe you had a slide on that.
Yep. So there's the slide I had on it. And if you go to, type in Joint Taxation Committee, CPA Canada and CBA, you'll probably find their official letter. I just took it from their official letter, just basically saying we need more time. Somebody asked earlier, and one of the good questions was about capital gain reserves. How are they going to be treated? Somebody asked about grandfathering, right? What if we sold something before the budget date, but it doesn't close until after June 25th? Are we going to be penalized because we're closing later, right? But we already had the deal done before the budget. Why can't we have an election mechanism like a V-Day value, like the 94? Why can't we have that? How will, if I have a trust that sells a farm now, technically that gain's allocated out to the beneficiaries at the end of the year. That's the way the act works. The same with a partnership. Lots of farm partnerships, right? Sell a farm out of a farm partnership today. Technically, it's allocated out to the partners at the end of the taxation year, which is usually December 31st. Will those gains be realized that they happened before June 25th? So we get 50%. Or is the government going to say, well, no, because the allocation of gains out of partnerships and trusts is the end of the year, you're now at the higher inclusion rate? That's not fair, and we would hope they wouldn't say that, to be honest, but we don't know. The corporations we talked about, gains and corporations are being highly penalized, so to speak, I think, relative to gains of individuals. Why not give a corporation? Why not give an estate? Why not give a trust the 250,000 limit per year also that they've given individuals? Like, it's a matter of fairness to some degree, right? And this 250,000 limit a year where you get to use 50% instead of 2/3, the ask is, will that be indexed? Like if it stays static every year, that maybe doesn't make sense. And if you don't use it, so say you have a $100,000 gain in 2024, so you haven't used 150 of it, right? You've only used 100 of it. And then let's say next year you have a $500,000 gain. Well, you get to only use 250 next year. The 150 you didn't use this year, if it's not carried forward, it's sort of lost. So now, it maybe becomes more difficult for financial advisors and investment planning and sale planning, trying to have, 250 or less year after year after year. And is the government going to let you, if I sold a farm to my child, and let's say I'd used all my exemption up and I sell a farm to my child and I get to use, I make, it's qualifying and all this stuff, and I get to use the 10-year reserve. And if it's below 250 every year for the following 10 years, are they going to let me use the 50% on that? it's a very large gain, but I'm using the reserve to spread it out, and I'm using it maybe to spread it out at 250 or less a year or around there. Are they going to say, well, no, you had one big gain in 1 year. We're not going to let you average it out over 10 years. Again, sorry, we just don't know the answers to those questions right now.
Okay. And then a couple others quickly, if we're able, although this one might be a bit of a long, there's a lot to it, which is, can you speak to the requirements to be considered qualified farm property? How do you qualify is the question.
Or which one, the gain exemption, the rollover?
I believe it's referring to qualified farm property for the lifetime capital gains exemption.
Yeah. So there's a number of tests there, and to be honest, to get into it all now would be like, I think, another webinar, to be honest about it. And maybe that's a good topic for another follow-up webinar. I mean, there's lots of rules around it. It can depend when you bought the farm. If you had a farm you purchased before June 18th, 87, and you didn't elect on it in 94, there's different rules that apply. Whereas if you have a post June 18th, 87 farm, if it's a partnership using the farm, there's different rules versus a proprietorship using a farm. With a proprietorship post June 18th, 87, there's a revenue test where you have to have at least 2 years gross farm revenue that exceeds your net income from other sources. Or if the farm is being used by a partnership, there's a separate set of rules there, and it has to be used by an eligible family farm partnership, which is another definition. Farms used by a corporation, like if you own a farm corporation and you own farms personally and your corporation uses the farm, they can qualify too. But again, there's a number of tests and conditions we'd have to go through. So it's fairly involved and complicated. And a lot of what we do is exactly that. We get engaged by people to say, is our farm qualified farm property for the gain exemption, number one? And number two, is it also eligible farm property for the intergenerational rollover? And if it's not for either of those, or it's for one and not the other, is there anything that can be done, right, to get it on side going forward? I would say getting on side for the gain exemption is generally easier than getting on side for the intergenerational rule. The intergenerational rule looks at all the years you've owned the farm and that you've used it more years farming than not farming, right? So if you've owned a farm for decades and decades and decades, but you've rented it out like more than 50% of the years, it won't qualify. Like rented it out not to a family member, it wouldn't qualify, and it would be hard to get that back on side sometimes. But with the gain exemption, sometimes we can come up with plans to get it on side. Now, if you're a full-time farmer, it's what you do, or even if you're a part-time farmer, but you're farming every day and weekends and nights on your farm, generally you would qualify. I would just say you'd want to go look at the whole proprietorship versus partnership thing, because we do find sometimes with the proprietorships, if somebody's working off the farm, that maybe their gross farm income is not higher than their off-farm income if they have a good off-farm job, and then it doesn't qualify. But you can do some planning maybe to use a family farm partnership, then properly planning to use a family farm partnership to get it back on side. So.
Okay. And then there was one more quick one. It's about a paperwork question. How do I file the election on a final return if electing to transfer qualified farm property to a child at higher than the Acosta Just base? Is there a particular form?
No, there's not. There's not a prescribed form. A prescribed form is, a form the government does, and it's there, and you go look for it and you fill it out. There is not one of those for that. What you will do is on the personal tax return, you will report the proceeds at the higher amount, the amount you want to trigger the gain you want. That's number one. Number two, what we do is just a matter of practice and just makes me very comfortable, is we have our own sort of letter we've done internally that we send to the Canada Revenue Agency saying so-and-so passed away, they own this farm at this lot concession, whatever, it would qualify under this provision of the act to be transferred on a tax-deferred basis to the child. But the legal representative of the estate is hereby electing to have that property shown at this value, disposed of at a certain value. and then we get the executors to sign that, and we just throw it in the mail to CRA and keep a copy in the file. It just gives me a lot of comfort to do that.
Absolutely. Great. And I think that is all the questions. So let me just say thank you so much, Kurt. We really, really appreciate your time here today and your expertise on a very quick coming and complex tax change. Anyone on the call, thank you for participating. If you have further questions or want to get a copy of the slides or the YouTube recording when it's live, we will be putting this on our YouTube channel. You can email to me directly. I will put my email address into the chat. And thank you all so much for coming.
Thank you for having me. I appreciate it. Have a great day. Take care.
Thanks, Kurt.